Welcome to the deep dive video update. And I always want to explain what I mean by deep dive because it might be a little bit different than what you thought if you're watching one of these videos for the first time. I do videos every day. I do a number of different weekly videos. And then this video is where I take charts that I'm looking at, but not really using right now. And I put them into this video because we have to look deeper to see if we can find some kind of clues as to what's happening in the market. Now, additionally, there are charts that I put in this video that I don't show in other videos, and those are mainly just for informational purposes. This is being prepared for Monday, January 27th. The first chart is for information, and I show it every week in this video. It's a long range of the VIX. The VIX measures fear. When the VIX is really going up, the market's going down. And when the VIX is going down, the market's going up. Well, over a period of time, we go into different ranges as measured by a 50-period exponential moving average. When we really went down in the financial crisis, the VIX went to a higher range. Then we came up out of that and spent a number of years in a lower range. Then after COVID and then going into 2022, we were in a higher range again. Now we're in a lower range. We've been going back up a little bit as the market's been a bit apprehensive, not performing as well as some people had thought, even though we just set a new all-time high for the S&P. We're seeing this going back up, but we don't really focus on that as much. What we do is we look at the overall range here, and we're in a lower range right now, but we can chop during periods of time within that range. Also, I do a number of different studies on the VIX itself, which measures fear, and a lot of those are shown in the videos that I do every day. This is a study that I will show if it's telling us something, but it's not really giving us a big signal right now. This is a correlation between the VIX and the S&P 500. And I also have a 5 period of the VIX up here where we've been tending to go down lately. But this study in the middle, this looks at the correlation. And when we're getting a very high reading, sometimes we might not be seeing that in the VIX and the other studies that we do, but we might be seeing that here. And that just means that maybe the market is getting ready to go down. We're seeing a really high rise in the VIX in relation to the S&P 500. And that just means the market is getting nervous. Well, we're getting a very low reading right now. Okay, then we look at the VIX, and then there's this other thing called the VVIX, or the volatility of the VIX, or the VIX of the VIX. And we just look at a ratio between them. We've been kind of chopping around, not really getting any real insight lately. We look for long periods of upward or downward movement. That means the market is really trending and moving in one direction or the other. Back in 2022, this ratio was really going up. Then when we finally started to come up out of that, this ratio really went down, and we just kind of been bouncing along ever since then, not really getting a lot of additional insight from this chart. But that could change going forward. We also look at the speed of the VIX as measured by the RSI, the Relative Strength Index, based on 9 periods, and that's shorter term. I look for extreme positive or negative readings. We're not getting one of those now, so I haven't been showing this chart. Then we look at the volatility of stocks as measured by the VIX, and the volatility of bonds is measured by the MOVE index, and then we do a ratio between the two. I mainly follow the red line here. That's a moving average of what this ratio is doing. Not really telling us all that much. It's not really going up. It's kind of flatlining right now, so I haven't been using this chart. Then we show the risk on versus risk off ratio. And how I measure that is looking at high beta stocks, the ones that outperform when we're going up. Unfortunately, they outperform when we're going down, meaning they go down faster, versus the equal weight version of the S&P 500, which are more conservative stocks because everything is treated the same in that type of an index. And usually when this is going up, that's more risk on. When this is going down, that's risk off, meaning they're getting out of stocks and getting into more conservative stocks, sometimes leaving the stock market and jumping over into bonds, which might be considered a flight to safety at some points. Not the way things are working right now. We have bonds really going down as interest rates have been going up. And then we look at the ratio between the two, and we've been really choppy so far in 2025. We were going up, and that was showing that the market was really going up too. And even though we set an all-time high this past week with the S&P, we're not really seeing any kind of a breakout with this ratio right now. Again, like some other indexes that I show here, I want to see really big moves either up or down, and that gives us more of an indication of what's happening. We look at the ratio between large caps and small caps. The large caps are measured by the Russell 1000, which is kind of equal to the S&P 500, and the Russell 2000 is a very popular small cap index. And when this is going up, that means the large caps are outperforming. When this is going down, that means the small caps are outperforming. Really choppy. We kind of started to break up here, meaning the large caps were outperforming, but so far in 2025, we've just been chopping along sideways. Then, just for informational purposes, I used to have an additional measurement on here. I would go back to the previous all-time high set in 2022 in January. Well, we've gone out of the scope of this chart, so I dropped that one off. Now I'm just measuring the low that we set in late October 2022. We were up 74.59%, almost 75% from that low. And then we set another low in October 2023 and we're up 48.67% from that low as of Friday's close. Then stockcharts.com puts out technical alerts. I cover these in the daily videos one day at a time. What I show here, this is for the entire week. And what's really kind of strange about this week is we had 1, 2, 3, 4, 5, 6 alerts triggered on Monday, and that's when the market was closed. Yeah, try to figure that one out. There's obviously some mistake here, but it was closed for MLK Junior Day, and then it ended up being the inauguration day as well. But we start at the bottom and then read up. And mainly when I'm showing this chart, it's looking at the colors. If we see a lot of blue or green, depending on what color you see, that means positive things are happening. If we see a lot of red, that means negative things are happening. And then I look at 5 indexes, and I'm kind of playing with the idea of adding a 6th index, the NASDAQ itself, where I look at the NASDAQ 100. That's one of the indexes I'm showing now. But the NASDAQ has been outperforming the NASDAQ 100 for the last 6 months, pretty much since last summer of 2024. And so I'm thinking, okay, that's looking a little stronger these days, and it's been continually outperforming the bigger stocks in the NASDAQ 100. Maybe I should include that there in this video. Let me know if you think, because this is the only place I show what I'm about to show you, is stockcharts.com has these things called technical scores. Again, it's on a scale of 0 to 100. The higher the score, the better looking that particular chart. And as I said, I look at the NASDAQ 100. I'm thinking about adding the NASDAQ. I look at the mid caps, the small caps, the Dow, and the S&P 500, which is the foundation of all the analysis that I do and all the programs that I teach and things, strategies that I personally implement. So coming in first place are the QQQs. Even though they did not set an all-time high this past week, they're still holding up fairly well. Came down a bit on Friday, but they're coming in first place at 85.5. Now, in second place is the S&P 500, which did set an all-time high. It set an intraday high on Wednesday and then a closing high on Thursday, and then we had a bit of a down day on Friday. And this is coming in at 81.6, where the first ETF, that's 100 stocks, and that's all growth. And so when that is really outperforming, it really outperforms and it tends to do better. Where the S&P 500 is more balanced between growth and value. The stocks that are in the NASDAQ 100 are in the S&P 500, but then there's a whole lot of additional stocks. So it'll tend to underperform on the way up, but it'll tend to hold up a little better when we're going down. But it's coming in second place right now at 81.6. When we get into the 90s with these scores, that's when something is really strong. Then in third place is the Dow, which has been lagging, but it had a good week. It's only 30 stocks, and a few of those stocks had earnings reports that were well received. And so that really helped the Dow do pretty good this week. And it's in third place at 78.9. Then we have the mid caps, which have been lagging. The hope was that interest rates would continue to go down when actually they're going up. And that tends to help mid-cap stocks. Well, interest rates have not been going down, and earnings can really take a hit when these companies have to pay more for interest that could be going to their bottom line. But still, they're holding up okay at 69.3. And then in last place, which everybody thinks should be in first place right now because of this January effect, that actually should start in December, it hasn't really happened. These are the small caps. This is the ETF for the Russell 2000 Small Cap Index coming in at 51. Now it's slightly positive because it's above 50, but it's been a real disappointment. In fact, I watch two different small cap indexes. I look at the S&P 600 and then I look at the Russell 2000 index, and both of them are camped under their 50-day moving averages right now. And that's acting as overhead resistance. Until they can get above those and close above those moving averages, they're going to have a hard time advancing. So that's one area. Even though I focus on the S&P, we're still watching these other areas of the market at the same time. Then some short-term charts. I have a rainbow. I show this periodically in the daily video, but usually I don't. But we're looking really good with the short-term trend. This is plotting moving averages going from 10 periods up to 50 periods. And we're above the rainbow and the lines are starting to turn up. So this just shows us, yeah, the short-term trend is clearly positive here. When we were going down, the lines were starting to get jumbled up. We actually fell below the rainbow, but then we were able to bounce up off the 100-day moving average and come back through the rainbow to set a new all-time high on Thursday. And then this was kind of coming in and out of the daily videos. This is an indicator that I created decades ago to use with a strategy, and I stopped doing the strategy, but I kept the indicator. Very simply, this is a 20-period moving average of the open, high, low, and close. And another little rainbow is created here. And you'll notice at the end of 2024 into 2025, we were having a hard time getting above this rainbow. These upper areas, which this green line, that's the 20-period moving average of the high, we could not get above that. And it kind of followed us down here. And then when we finally broke through the rainbow and closed above it, that's when things were turning back more positive. And now we're above all these lines and the lines are starting to go back up. I usually only show this chart when we're dealing with the rainbow itself. Otherwise, I just show it in this video just to see, is the rainbow going up or is it going down? Intermediate term, another rainbow going from 50 periods up to 100 periods. And the 100 period moving average did hold, and we were able to bounce up off of that. We're back up out of the rainbow. We didn't spend a lot of time in the rainbow, so the lines are still pretty much flat. So this is turning the intermediate term trend back to positive. And then Bollinger Bands. I did show this earlier in the week because after we had that all-time high on Thursday, we actually closed a little bit above the upper Bollinger Band here. And that's what the percent B indicator measures. Do we close above or below the upper or lower band? And that tends to not last very long. It only lasted one day. And then it changed on Friday. So it's not in the current daily video. But there are times when this might be in a video for 2 or 3 or 4 days at a time. And that's usually meaning that prices have become pretty extreme pretty quickly. Then we just want to keep an eye on how far away are we from the 200 period simple moving average. That's the line in the sand between positive and negative. And we're above the 200-day moving average and everything is green here. So we're looking good there. This just suggests the long-term trend is still positive. And then I have another rainbow chart to show in a moment. And then we just do another measurement from the October 2023 low up to Friday's close. Now, when we were starting to go down from that all-time high that was set in early December, I was keeping a percentage track down here, but we didn't come down to the 10% level. We almost got to 10% with when things really started to dive back in August, and then we bounced up out of that. We were down a little bit over 5%, between 5 and 6%. And I have to eyeball these measurements, so they're probably not exact. And then we've been able to bounce up. We set the all-time high, but we were down a little bit on Friday. And then here's another momentum oscillator. And I only show this one when we're extreme positive or negative. We're not now. So I haven't been showing this one. These are anchored moving averages, which are a variation of regular moving averages, where a moving average will use back data to calculate the current value. An anchored moving average, you attach it to a high or a low, and then it projects forward from there. And we did break down below this short-term anchored moving average, but then we were able to get back above that. And I haven't been showing this chart. I think I showed it once or twice when we were below this red line, but As long as these other lines continue to go up, this is just suggesting that the trends on the short, intermediate, and long term continue to be positive. And then we were really focused on this for quite a while. The 50 period moving averages, both a simple and exponential version, well, we're above that. And as long as we stay above it, there's been no need to show this chart. I have a different chart that I do show in every video. I call it a moving average tree. It looks like a bunch of spaghetti. Or I have 20, 50, 100, and 200s all plotted on the same chart. And then this was the 100 period moving average that became very important a few weeks back when we were really coming down. We came down below the 100-day moving average, but we closed above it. And we closed 1 day, 2 days, and then 3 days above the 100 period moving average. And then we were able to bounce up out of that. So this was a support level that held. And we're far away from that now. So I stopped using this chart in the videos. We keep an eye on the S&P 100, which are the biggest stocks that make up the S&P 500, just to see if there's any real disconnect between these two charts. Really not happening right now. And then here's a long-term rainbow going from 50 periods up to 250 periods. We did come down into the rainbow. We had support here at the 100. That's the green one here. And then we've been able to come up out of that. And as with the short and intermediate term, we didn't spend an awful lot of time in this rainbow, so it barely moved the lines. They're still going up. And that's why even when we were coming down, I could still comfortably say that the long-term trend was still positive. And this just confirms that. And now we're back up out of the rainbow again. This is a long-term oscillator that I look at every day, but I don't talk about it because we only get one or two signals a year. It's been over a year now since we got the last signal here when we crossed above the red line. This is a special K, a very long-term oscillator. It continues to be positive and above the red line, and both the oscillator and the red line are going up, and that's long-term positive. We want to keep an eye on the European markets, with the German market being the biggest market in the EU. And so we look at a weekly chart on the top of the S&P and a weekly chart of the German DAX in the middle and look at the correlation between them. Now, we're setting all-time highs in Germany right now. We did set an all-time high in the US, so that's a confirmation, but we're seeing German stocks have been really strong lately. And so not as strong as US stocks. That's why we're seeing this correlation coming down just a little bit right now. Then some support and resistance. I readjusted these when we set the new all-time high here on an intraday basis because we did set a new intraday high on Friday, but then we ended up closing down. The closing high was set on Thursday, and so they're not exact here because I have to eyeball this, but we're far away from this 61.8% retracement level. We really only use these if we really start to scream to the downside and we're in danger of hitting one of these areas. And coming off of an all-time high here, we're not close to those now. Okay, then we look at the NASDAQ 100 volatility as measured by the Vixen. That's the equivalent to the VIX for the S&P 500. And I don't really pay attention to this all that much. I get enough information just from the VIX itself. But if some of you are involved in the NASDAQ 100 or the QQQs and things like that, then you probably pay attention to this quite a bit. The Qs, I do watch them though, and we were really relying heavily on this. As we were going down, we did drop below the 50 period moving average of the Qs, and that was negative. But then we were able to get back above that and then get back above the shorter term 20 period moving average. And this was actually turning positive before we were seeing things turning positive with the S&P. And now we're above all the moving averages here, and we didn't see a cross. So everything is looking more positive for the time being. Then we look at the S&P on top, and then we do a ratio of growth to value, the Qs to the diamonds. And we see that right now that relationship is neutral. We're not really getting anything all that significant on this study. We want to keep an eye on the Dow, and I look at charts every day, but then we also want to keep an eye on the transports, which really have been chopping sideways again. They look like they were doing better, only to fall back into a range, and they're continuing to underperform the Dow. We want to keep an eye on the financial sector and then different areas within the financial sector. This is a ratio between regional banks and the financial sector itself. We're just chopping sideways right now. Now, I have been watching another ETF that I usually include in this video, but I'm now using it in the daily video, and that's a bank ETF that cannot seem to get above and stay above its 50-day moving average. Another thing that is positive. Now, the financial sector is positive, but it'll be even more positive if that bank ETF can get above the 50-day moving average and then stay above it. These are for informational purposes, long-term rate of change charts. We go back to Friday's close and then 250 periods ago. We're still looking pretty good here. There's another one going all the way back to 1980. After we had been declining coming into the end of 2024, we possibly are starting to go back up now. And I do a lot of studies with bonds, but I don't show all the charts that I have in the other videos. This kind of comes in and out of the videos from time to time. This is a ratio between cash and 3 to 7 year bonds. And when this is going up, that means cash is outperforming the price of 3 to 7 year bonds. You'd be better off just hanging on to the money. Well, the context of that, when this is happening, is that there's uncertainty about interest rates, and interest rates have been going back up. And that's kind of freaking people out with the Fed coming in and cutting rates. And there's a little bit of concern about inflation coming back into the picture. And that's why we've been seeing this ratio going back up. Same basic concept here, but it's not as drastic. We look at tips, which do adjust for inflation. They're treasury inflation protected securities. When this is going up and the ratio is going up, that means there are inflation worries. We're not seeing a lot of worries based on this chart. It's actually going sideways right now. So nothing of real concern is coming out of this one. But if we go tips to 3 to 7 to 10 year bonds, we go further out. Yeah, there's some inflation coming back in as the longer term bond rates, the 20 year and the 30 year, those interest rates have been going up, and that's causing this ratio to go up. And so there are some concerns. Now, in the upcoming week, we're going to have the Fed coming out, making their announcement. They're probably not going to change rates. They pretty much said they won't. But what are they going to say in their comments? What's the press conference going to offer to us? We have the first look at GDP coming out for the fourth quarter of 2024. That has an inflation component. We're going to get the core PCE. We're going to get jobless claims. So there's a lot of inflation data and inflation things that are going to be coming out, in addition to what's already happening with the new administration and all the executive orders and all the things that are changing really quickly right now. So we'll see if this ends up adjusting. But for right now, there are inflation concerns coming into the market and have been now for a while. We look at the long-term bond ETF, which is in blue, and we compare it to the S&P 500, and we do a short-term correlation, which is here in the bottom area, 10-period correlation. It's fairly strong, but wearing off lately. And here's a long-term correlation, which was getting stronger, but now starting to taper off just a little bit. We do that same thing. Instead of looking at the S&P, now we look at the QQQs. That correlation is neutral right now. We're right at zero currently. Can't get much more neutral than that. Then another thing that we look at between the US and Europe is we take the 10-year yield and we subtract the German 10-year yield. And since US rates are higher, that's why we have a result that's above this red line of zero. And we compare it to the US dollar index. And believe it or not, somebody actually thought this thing up. I didn't do this myself. But there's a pretty strong correlation between that. And that means that the takeaway that I get from this, everything's okay right now. We're not seeing anything really imbalanced at this time between the US and Europe and the dollar and all of that. Then we want to keep an eye on the 2-year Treasury yield. It's been chopping sideways right now, so not really giving us much insight there. Keeping another eye on things going on in Europe, we look at the Eurozone ETF and compare it with American bonds. And as the Eurozone's really been going up and we're seeing strength mainly in Germany, we're coming up out of the rainbow here, where we had spent a considerable amount of time below the rainbow. And then I have things called the possible positive scenario charts. I use a lot of those in the daily videos, but what I'm going to show here, I don't use all that much. This is a study that shows the percent of stocks in the S&P that are above their 200-day simple moving average. I use this chart like an oscillator. I have a different chart that's the same thing, but I interpret it a little bit different way. This one is we're looking for extreme positive or negative readings. We're not getting those. And when we're above or below 50. And we came right down to 50, and that's when we started to bounce back up. So this is turning back more positive now. And we did that same thing with the S&P, but we look at the 50 period moving averages. We're back above 50. We're not extreme positive or negative now. So we're looking more positive here. And we look at the mid caps, also showing an improvement, as well as the small caps. And 50 is kind of the line in the sand between positive and negative. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.